Well, is a double dip in the cards? Our next guest warns the world economy could stumble in 2010. Still, he's confident the corporate sector can weather the storm. And here with his outlook is Gurwitz. He's a managing director and head of global investment strategy at Barclays Wealth. And Aaron, great to have you with us. So a double dip, we've heard that from Roach, we've heard that from Krugman. Is this actually a more prevalent view than what we're giving credit for?
Well, I think the prevalent view is that there's a serious risk of a double dip, not that there will be a double dip. We, in fact, do not expect that there will be, but we want to manage our portfolios and give our clients advice on the assumption that there is a substantial risk.
Okay, and Roach, for instance, Stephen Roach, I'm talking about, chairman of Morgan Stanley Asia, gives it possibly a 30 to 40% chance. Where do you stand on this?
I think we're about there. We'd put a 40% probability on a really weak second half of 2010. Whether that involves a double dip, by the precise definition or not, we don't know, but it's a high probability. And
all of this happening at a time, though, when we're seeing risk appetite come back.
Yes, it's an odd situation because what we see is that the macroeconomy, and in particular governments and households, are struggling. But the corporate sector is actually doing quite well. Now, not as well as they would be if everybody else was just fine, but they seem to be able to hold their own.
But is that because inventories are coming back?
Inventories are coming back, but mostly because productivity is so far up. Corporations went into this cycle prepared to cut costs very sharply. And we've seen some really eye-popping productivity growth numbers in the U.S. and elsewhere.
But isn't that going to fade, though, at some point?
It will fade as the economy picks up. I would love to see those numbers lower, because what we're seeing is that corporations are able to produce profits, but they're not able to produce jobs just yet.
Right, and so the question is, can they hold that momentum then, right? Or
that's the key. 64 quadrillion question.
Okay, so then where would you be moving into in this cycle that you're talking about?
Well, we think we're in what we would call a mid-cycle phase. In other words, the explosive portion of the recovery is over. We have not entered the next downturn. We don't know when that's going to be, but of course we never know when that's going to be.
Right.
And so we're in a mid-cycle phase, and we're looking for investments that tend to do well when the markets are relatively stable at mid-cycle. Non-cyclical equity sectors, for example.
Okay. All right, Aaron, thanks so much for joining us. Gurwitz from Barclays Wealth. And guys, we are actually just only moments away from the ISM, the service number, which some might say could be a bit more important in terms of gauging where the economy is going. Well,
Aaron just mentioned that we've seen a lot of job cuts. The Challenger report today showing that from the first half to the second half of the year that the retail industry job cuts taking down about 85%. So this ISM reading now tells us, okay, what's happening with the actual business now that retailers, for example, have cut so many jobs.
Yeah, that's exactly right. And remember, when you're talking the ISM non-manufacturing, you're talking about retail, healthcare, finance. No wonder this has lagged the ISM manufacturing. So obviously we get this thing back above 50. That does bode very well.
Aaron, your view on this?
I mean, the jobs will become very important as the year progresses. If we do not see some noticeable job growth that's sustainable by the second half of the year, that means we're in trouble.
Okay.
So 10-2 might actually be, what, good news if we get that for unemployment on Friday?
It wouldn't be a terrible surprise. It wouldn't be a downside surprise to see unemployment continuing to rise at this point. The last two numbers were a little fluky. 2 months ago, too high. Last month, a little bit lower than.
Okay, we've got to leave it there.